Hey there, traders! Welcome back to the channel. Today, we're diving into one of the most powerful yet underutilized indicators in Forex trading, the Money Flow Index, or MFI. If you've been struggling to identify the perfect entry and exit points for your trades, or you're tired of indicators that only show you half the picture, this video is exactly what you need. The Money Flow Index combines both price movement and trading volume to give you a complete view of market momentum. Think of it as having X-ray vision into the market's buying and selling pressure. By the end of this video, you'll know exactly how to use the MFI on any Forex pair, whether you're trading EUR/USD, GBP/JPY, or any other currency combination. Let's get started. So, what exactly is the Money Flow Index? The MFI is a momentum oscillator that measures the strength of money flowing in and out of a currency pair. It oscillates between 0 and 100, just like the popular RSI indicator. But here's the key difference. While the RSI only looks at price movements, the MFI adds volume into the equation. This makes it a volume-weighted RSI, giving you much more reliable signals. When institutional traders, the smart money, start accumulating or distributing positions, the MFI picks up on this activity through volume changes. This is why many professional traders call it the smart money indicator. Quick pause. If you're finding this helpful so far, smash that like button and subscribe to the channel. We release new trading strategies every week and you don't want to miss out. Hit that notification bell too. All right, let's continue. The MFI uses three critical zones to generate trading signals. First, the overbought zone, above 80. When the MFI rises above 80, it signals that too much buying pressure has pushed the price up. The currency pair might be overextended and due for a pullback. Second, the oversold zone, below 20. When the MFI drops below 20, excessive selling pressure has driven the price down. This could signal a potential bounce or reversal to the upside. Third, the neutral zone, between 20 and 80. This is where the market is in balance, and we typically wait for clearer signals before entering trades. Now, let's talk about practical trading strategies you can use on any Forex pair. Strategy number 1, overbought and oversold signals. Wait for the MFI to cross above 80, indicating overbought conditions. When it crosses back below 80, that's your signal to enter a sell trade. Place your stop loss above the recent swing high and target the next support level. For buy trades, wait for the MFI to drop below 20 into oversold territory. When it crosses back above 20, enter a long position. Place your stop loss below the recent swing low. Strategy number 2, divergence trading. This is where the MFI really shines. Divergence occurs when price moves in one direction, but the MFI moves in the opposite direction. Bearish divergence. The price makes higher highs, but the MFI makes lower highs. This warns that buying pressure is weakening and a reversal down is likely. Bullish divergence. The price makes lower lows, but the MFI makes higher lows. This suggests selling pressure is exhausting and a reversal up could happen soon. Divergences are incredibly powerful signals and often precede major trend reversals. Now, let's take it to the pro level with strategy number 3, hidden divergence. Unlike regular divergence, which signals reversals, hidden divergence signals trend continuation. It's my secret weapon for joining strong trends. Hidden bullish divergence occurs in an uptrend when price makes a higher low, but MFI makes a lower low. This tells us the pullback is oversold, but the structure is still bullish, a perfect buy signal. Conversely, hidden bearish divergence in a downtrend is when price makes a lower high, but MFI makes a higher high. This indicates a temporary rally that is running out of steam, a perfect opportunity to sell and rejoin the downtrend. Strategy number 3, combining MFI with moving averages. For even stronger confirmation, use the MFI alongside a moving average, like the 50-period or 200-period MA. When price is above the moving average, and the MFI crosses above 20 from oversold, that's a high probability buy signal in an uptrend. When price is below the moving average and the MFI crosses below 80 from overbought, that's your signal to sell in a downtrend. This combination helps you trade with the trend while timing your entries perfectly. Strategy number 5, multi-time frame analysis. Never trade in a vacuum. I always start with the daily chart to determine the big picture. If the daily MFI is above 50 and rising, the momentum is bullish. Then, I drop down to the 1-hour chart to find my entry. I look for the 1-hour MFI to dip into the oversold zone while the daily is still bullish. This ensures I'm buying the dip in a major uptrend, rather than trying to catch a falling knife. Aligning the higher time frame momentum with lower time frame entries significantly increases your win rate. Let's put this all together with a live trade example on GBP/USD. Here, we see price is below the 50-period moving average, confirming a downtrend. We check the daily chart, and momentum is bearish. On the 1-hour chart, price rallies, creating a lower high, while the MFI spikes up into the overbought zone above 80. This is our trigger. We enter a sell trade as the MFI crosses back down below 80. We place our stop loss just above the recent swing high, giving the trade room to breathe. Our take profit is set at the next major support zone, aiming for a risk-to-reward ratio of at least 1:2. This is disciplined, systematic trading. Before we wrap up, here are some crucial tips for using the MFI effectively. Tip 1. Don't use MFI in isolation. Always combine it with price action, support and resistance levels, or other indicators for confirmation. Tip 2. Be patient during strong trends. The MFI can remain overbought or oversold for extended periods when momentum is strong. Wait for the crossback into the neutral zone before acting. Tip 3. Adjust the settings if needed. The default period is 14, which works well for most timeframes. But you can experiment with shorter periods for faster signals or longer periods for smoother, more reliable readings. Tip 4. Practice on a demo account first. Test these strategies on different currency pairs and timeframes before risking real money. And there you have it, a complete masterclass on the money flow index. We've covered the basics, advanced hidden divergence, multi-time frame analysis, and a complete trade walkthrough. Remember, trading is a marathon, not a sprint. Use the MFI to identify high probability setups, but always respect your risk management rules. If you found this extended guide valuable, please give it a thumbs up and subscribe. Drop a comment below with MFI Master if you watched until the end. Check the description for our broker recommendations and free resources. Thanks for watching, and I'll see you on the trading floor. Trade smart.